Hello dear students. In this video, we will discuss marginal costing. So I am Dr. Indrani Katti. Here, and this marginal costing is a very important chapter for BCom final year, that is 6th semester. You are learning management accounting. In that, very important chapter is marginal costing. So let us learn about how about the marginal costing. What is marginal costing? It is a process wherein a marginal cost is ascertained and the management will also take a decision about the increase in the sales, the impact of increase in the sales on the increase in the profit. So what proportion or to earn the desired amount of profit, what should be the increase in the sales? So there are so many decisions which are made by the management by using the marginal costing technique. So that's why we tell this is the best technique. This is a very important technique which is used by the management to take various decisions. So what are those decisions and all? We will deal with that in the next slides. So let us come to the meaning of marginal costing. So marginal costing is a process of ascertainment of marginal cost. That is, what is the marginal cost, that is additional cost, and of the effect on profit of changes in volume or type of output by differentiating between fixed cost and variable cost. So this is a very important concept. The total cost is in this marginal costing is divided into two parts. That is, one is variable cost, one more is fixed cost, and variable cost is associated with the marginal cost. So based on this variable cost, based on this marginal cost, the management takes the decisions, right? So here one more concept comes that is called as cost volume profit. This is, in short, we can tell CVP analysis. It is a technique which is used by the management to evaluate how costs and profits are affected by changes in the volume of sales. So what proportion of sales leads to change in the proportional cost increase or decrease, or in the proportional profit. So is it in proportion it changes, or in different proportion it changes? So let us learn that all in the next series. Come to the different types of managerial decisions. What are those? Management takes important decisions by using this marginal costing technique. So what are those decisions? One is make or buy decision. It means whether the company has to manufacture the components required to manufacture a product. In the company itself, it has to manufacture or buy it from the outside sources, from the market, and then assemble it and sell and make a profit. So whether to manufacture in the company or buy it from the outside. So this decision can be taken by the management by using the marginal costing technique. Second one is exploring global market or foreign markets. So this is what a foreign order, whether to accept a foreign order or reject. So based on the variable cost, based on the marginal cost, management take decisions. And accept an order or reject, fixation of the selling price. So to earn the desired amount of profit, what must be the selling price, right? So to fix selling price also, so that the company can earn the desired amount of profit, what should be the selling price? So this is what is used. To replace one product with some other product. So diversifying the business, replacing the products, mixing different products. So there are so many things, so many decisions which are made by the management by using this marginal costing technique itself. Okay, now let's move on to the understanding what is marginal costing and what is the marginal costing equation. Using this basic equation, the management is going to take various types of decisions. Okay, so what is this all about? Let us focus on this, right? See now. Here, it is a costing system which treats only the variable cost as a product cost. And this fixed cost is not a product cost, but it is a period cost. Okay, so that's why here is the equation. We can look at the equation. Marginal cost equation is sales minus variable cost is equal to contribution, and that is equal to fixed cost plus or minus profit or loss. So whereas these are the notations, S is meant for selling price, V is variable cost, C is contribution, and F is fixed cost, P or L is profit or loss. So there is one more concept which is very important, that is called as PV ratio. That is also called as contribution to sales ratio. So how it appears in all, looking to this, we can understand, right? What is this as sales is equal to cost plus profit. As all of us know, what is sales? Sales is equal to cost plus profit. So let us move on to this. Here, let me go to the screen. Here you can understand the basic principle, the basic, what do you say, equation, that is sales is equal to cost plus profit. So this is what is known to everybody, okay? In this cost, we add on the profit portion, then we will arrive the selling price or sales. So here, this cost, total cost is categorized into variable cost and fixed cost, okay? Now, this fixed cost is a decision-making concept based on the variable cost, based on the change in the marginal cost. There'll be a change in the profit also. So what is that cost? To ascertain the marginal costing is going to help. So let me present it in the vertical form. That is sales, selling price we can take, minus variable cost. It is contribution, and minus, if we deduct the fixed cost from the contribution, we will derive the profit. Okay. So here, what do we do is simply, let me explain this with a small example. Here is the selling price is 100 rupees, variable cost is 40, and your contribution will be 60. And fixed cost, that is not a product cost, it comes to a period cost. That's why per unit fixed cost is not ascertained. And what will be the profit? So if you multiply this with the number of units, if suppose 1000 number of units are manufactured, we will have to multiply it with 1000 units. How much we derive here is 1 lakh total sales. Okay. Again, multiply this variable cost with 1000 units. And how much we get here is 40,000 as a total variable cost. And the contribution, total contribution will be 1 lakh minus 40,000. We derive 60,000. And in this variable, this fixed cost is deducted. So it is a period cost. It is not a per unit cost. That's why total fixed cost should be taken here. Say here it is again 40,000. What is your profit portion? So the profit portion is leftover thing, 20,000 is a profit portion. So this statement is an income statement. Based on this income statement, we are going to take so many decisions, being the management of the company. Okay. So what is this is these two concepts you see, this contribution and selling price and variable cost. Don't come to the lower part, that is fixed cost and profit. Based on these variable cost, change in the variable cost, or what is the selling price, product cost, that all we are going to consider for that variable cost as a major decision-making cost. Based on this only, we will decide whether to manufacture here or buy it from the outside, whether to do the sales mix or not, whether to accept the foreign order or reject it. So many varieties of decisions are taken based on the variable cost. So variable cost plays a greater importance here. It plays an important role for this decision making. See now, in this only, we can look into this matter. Here we are connecting these two concepts, that is contribution and selling price. What is a percentage of contribution to the selling price? Itself is known as PV ratio. It is called as PV ratio. So PV ratio is also called as CS ratio, right? So this is all about understanding the marginal costing statement. So the same itself, selling price minus variable cost is equal to contribution, and contribution minus fixed cost is equal to what do we derive as profit or loss. So let us come to the same example. We will discuss how the thing is explained over here or understood in this. Selling price or a sales, variable cost, contribution minus fixed cost is equal to profit or loss will be there. So selling price, as we have taken in the earlier problem, as 100 multiplied by 10,000, 1,000 units. So this is 1 lakh. Okay. And variable cost was 40. Here it is 40. Okay. Well, 40, it is 40,000 in total. Right. So how much contribution we got? 60,000. Minus fixed cost is again 40,000. And the leftover profit is rupees 20,000. See, now we are learning the derivatives of this income statement. That is sales or selling price minus variable cost equal to contribution. And that contribution is equal to fixed cost plus profit. This is the basic marginal costing equation. Okay, let us look at that. This contribution equal to fixed cost plus profit. Fixed cost plus profit, if you add these two, fixed cost and profit, we will derive 60,000, or sales minus variable cost, that is sales 1 lakh minus 40,000, we derive the contribution. So contribution, based on the contribution, we are taking much more decisions. Based on the variable cost, we are taking decisions. So here PV ratio plays a greater importance. That's why to take the decision, whichever results in, which option gives you more PV ratio, that option is selected. Don't go for the, what do you see, the amount, but let us convert that into percentage and learn and take a decision, right? So in the next slide, we'll look at these also, okay? And here, you know, the basic thing, what you have learned is marginal costing equation. Okay, and now we will get back to this. We will get back to the slide. Sales minus cost. Sales is equal to cost plus profit. So sales is equal to variable cost plus fixed cost plus profit. This is what is a cost is categorized into two parts, that is variable cost and fixed cost. Okay, and then we add the profit portion to the total cost. That is what is sales amount we derive, right? So here only, that's why the same statement is presented here as sales minus variable cost, that is equal to contribution. And if you deduct the contribution, if you deduct the fixed cost from the contribution, we will arrive the profit or loss. Okay, more the contribution, there will be a profit. Lesser the contribution compared to the fixed cost, then we derive the loss, right? And this is the center part of this statement is contribution. More the contribution, good for the company. Lesser the contribution, it's not, what do you see, favorable to the company. Okay, so don't forget this marginal costing equation. And for all the time, we make use of the contribution and make the decisions. So the next concept is break-even point. So what is break-even point will be discussed in the next slide, in the next video. So this is what a little bit of marginal costing, the introductory part of marginal costing. First, make sure, learn it better, understand the concept, then we will move on to the break-even analysis, how the break-even analysis is made and what is break-even point. Everything we will learn in the next slide. I hope you understood all this. And let me stop sharing here itself and come to the main screen. And if you have any type of queries related to the introductory part and understanding of marginal costing technique, feel free, write it in the description box. I will attend those queries, right? Thank you.